Before any gold standard could be contemplated, there would have to be an audit, a proper audit, an independent audit of US gold reserves. I don't see that happening.
Maybe what we want to do is devalue the hell out of the dollar, revalue gold. Who benefits who? Well, it certainly benefits us with all the gold we've been bringing back. And maybe to Alasdair's point, all this gold we've been bringing back and not telling anyone about, do you think that the only gold coming back is coming back through COMEX? Hell no, it ain't. It's coming back through proxy banks and to JP Morgan's vault. And there's so much more gold coming back than is just being recorded on COMEX. I guarantee it. So we bring all this gold back and then we devalue the hell out of the dollar and revalue gold to a level that not only benefits, but it benefits all the central banks of the world who have been accumulating it hand over fist since 2016 and 17.
Leading global experts, Alasdair Macleod and Andy Schectman, take very different positions on the idea of a U.S. gold revaluation. Macleod argues that any discussion of revaluation is premature. The government has never conducted an independent audit of its gold reserves. In his view, such a move would only occur in the wake of a full-blown crisis, a collapse in confidence in fiat currency. Until such a shock forces the issue, he believes the idea of revaluation remains theoretical. Schectman sees it differently. He argues a revaluation is not only possible, but already on the table. His math is simple. For every $4,000 increase in gold, the US Treasury effectively gains $1 trillion. A revaluation to $24,000 an ounce, a figure James Rickards has proposed, would hand the government roughly $6 trillion. That could function as a soft default, a way to stabilize the bond market and support the reshoring of US manufacturing as $28 trillion in debt matures by 2028. In this scenario, no gold changes hands, and no vaults are emptied. It would be a balance sheet adjustment that transfers value directly to the Treasury, without raising taxes, borrowing more, or cutting spending. Schectman goes further, claiming the U.S. has been quietly repatriating gold through JP Morgan in preparation for such a move. He even points to reports that Donald Trump once planned to issue gold-backed treasuries by July 4, 2026, as part of a coordinated effort central banks have allegedly been preparing since 2016. Before we dive into Alasdair Macleod and Andy Schectman's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
No, I don't think. I think all this talk about gold revaluation is premature. I really do. Apart from anything else, we all know, I mean, the world's biggest open secret is that the US Treasury doesn't exactly have 8,130 odd tons, which it states it has. How much it has, I really don't know. Before any gold standard could be contemplated, there would have to be an audit, a proper audit, an independent audit of US gold reserves. I don't see that happening. The other thing is that the system, that both the Treasury and also the Fed don't understand basic economics. They don't understand why money, corporeal money in the form of gold, is so important. It anchors the value of credit. They don't understand this at all. They're macroeconomists. They're not classical economists who, over centuries, work things out. That was all discarded by Keynes in 1936. In favor of governments manipulating our lives. So we're talking about climbing down completely from that sort of situation where governments actually have an awful lot of discretion as to what they can do with their currencies. I just don't see it. I mean, it's people who think that this is going to happen. I think are people who fundamentally believe that things are under control of the government and government can just turn around and do things slightly differently. That's not the case. They really cannot.
He's the smartest guy in the industry. So I say this with respect, and I'm going to take an opposite viewpoint on this because I've been trying to think how we get out of this sticky wicket. I'll just cite two other things real quick before I jump into that. Michael Hartnett, analyst at Bank of America, came out just the other day and said central banks will be forced to revalue gold reserves to reduce domestic debt burden. Very positive for gold. And then Francisco Blanche, Bank of America Securities, says gold revaluation bullish for gold, showing it's no longer a barbarous relic but a key asset for central banks. Now even the biggest central bank of them all is taking a renewed interest in gold. He said that on Bloomberg TV the other day. So here's the deal. Every $4,000 increase in the price of gold would give the Treasury General account 1 trillion free and clear. Put gold at $10,000, they get 2.5 trillion. And that's the number that Mike Maloney came up with by using M1, dividing it into the money supply. Guys like James Rickards said 24,000, and he has another metric for doing it at $24,000. I want to suspend everything we know about logic right now and just say at $24,000, it would give the Treasury General account 6 trillion free and clear to work down their debt. What it would really do is devalue the dollar. Now, I want people to think about this for a moment. If Trump really does want to reshore manufacturing, which I do believe is a noble cause and must be done, 60% of this country has no college education. AI is going to eviscerate and kneecap a lot of white-collar jobs. We need to put people to work. But we have $28 trillion coming due, you guys, in 3 years in treasuries that are maturing. By 2028, we owe $28 trillion. We have a $3 trillion a year spending deficit, right? So that's another 9. 28 and 9 is 37. We take in $5 trillion a year in tax revenue. What the hell do you do there? You're halfway there. Not even, you're a third of the way there to what you owe. So my feeling is they're going to destroy the value of the dollar to support the bond market in order to bring back manufacturing. Let me explain. I do believe they will revalue gold. Maybe what we want to do is devalue the hell out of the dollar, revalue gold. Who benefits who? Well, it certainly benefits us with all the gold we've been bringing back. And maybe to Alasdair's point, all this gold we've been bringing back and not telling anyone about. Do you think that the only gold coming back is coming back through COMEX? Hell no, it ain't. It's coming back through proxy banks and to JP Morgan's vault. And there's so much more gold coming back than is just being recorded on COMEX. I guarantee it. So we bring all this gold back, and then we devalue the hell out of the dollar and revalue gold to a level that not only benefits us, but it benefits all the central banks of the world who have been accumulating it hand over fist since 2016 and 17. Hand over fist. Look at the charts. They're the ones buying it all. They're not going to care. They're not going to be as pissed off when they've been buying it all. So the act of devaluing the dollar and revaluing gold so that, as Judy says, you can peg the back end of the curve to gold. What does that mean? That means zero interest rates. So the back end, you put a zero coupon bond redeemable in gold. The more stupid we are with monetary policy and the more irresponsible we are with fiscal responsibility, the higher the price of gold goes. It acts as the interest rate. It acts as the inflation hedge. You can't put 8-10% interest rates on the long end of the bond, or stocks, bonds, real estate, the stock market, and the banks and the insurance companies go boom, just like that. You saw what happened when the long end went above 5%. The banks started to die. Put them at 8 or 9%. The real measure of inflation is so much higher than the BS, the BLS tells us. Look at the revisions on their unemployment the other day, where they said, yeah, the 300,000 or 400,000 jobs we said were created, it's only about 70,000. So they continue to disappoint us and lie to us about the CPI, where you talk about things like food, energy, and housing aren't in there, or the hedonics where they change it if steak is too expensive. We're not trusted anymore. None of this stuff works, right? So you peg the back end of the bond market, redeemability in gold, and you devalue the dollar. What does that enable us to do? Well, that enables us to bring home our manufacturing at zero interest rates and reestablish our manufacturing base with a very weak dollar and low interest rates allows us to sell our goods to the rest of the world.
If they were to refix the dollar to gold at that sort of level, I think two things immediately occur to mind. First of all, would I be able to exchange gold for, my dollars for gold? The answer is probably
no,
not.
Backing the US Treasury. No, it's backing the Treasury, not redeemability in the currency.
Yeah. Okay, that's the first thing. The second thing is we're talking about something like a 1,000% inflation kick on prices all in one go. And I just can't see. Basically, you're saying that this is a deliberate act to destroy the economy. It's actually as simple as that. And I just don't see it. I can see them trying to put off the inevitable forever and ever and ever until finally they can't. But I think this sort of concept, and you see, the other thing is the first thing. Let's say the first step. Right, we'll audit the Fed. Okay, that's fine. immediately you'll have all the other countries who have stored gold with the Federal Reserve Bank of New York saying, hey, how about us? Can we come and look at our gold? You turn around and tell the Germans that they weren't allowed to inspect their property back in, 2012 or 13 or so. You're opening a can of worms as soon as you start talking about gold. This is the problem. And it's always for this reason that anyone who's gone into the Treasury, who was a gold bug or whatever before, going back to Alan Greenspan, the first lesson they learn is do not talk about gold. No comment. It's not on the agenda, for whatever reason. I suspect, and I think you probably suspect, Andy, that so much gold has disappeared from US Treasury vaults over the years. We're talking about 54 years of suppressing gold, trying to persuade everybody that it is no longer money. It's a pet rock. This is a very, very big hole, if you like, in national reserves, and nobody could possibly admit to it. So I'm not convinced. I just don't see it. And a deliberate act of hyperinflation. No, I think hyperinflation by accident, yes, but not something that is going to deliberately do it. Oh, and another third point, and I'll just leave it at that. We know that Russia and China have got more gold than anybody else, like huge quantities. This would enrich them hugely. I just don't see it.
Alasdair Macleod warns that it's not gold that's suddenly rising. It's fiat currencies collapsing under the weight of unpayable debt. After 54 years, the paper money experiment is cracking, and the evidence is stacking up fast. Central banks are pulling gold from the Bank of England. Open interest on COMEX is shrinking even as prices rise, signaling stress in the paper market. And since late 2022, the United States has flipped from being a net exporter of gold to importing more than $100 billion worth. These shifts aren't minor. The surge in physical deliveries on COMEX and the reversal of U.S. gold flows indicate a fundamental transformation in the precious metals market. Andy Schectman underscores the point by citing metals analyst Bruce Ikemezu, who reports that physical platinum in London is nearly depleted. When exchanges are stripped of inventory while demand for delivery continues to grow, the setup for a bear squeeze becomes unavoidable. Both Schectman and Macleod believe that's precisely what's playing out now. Precious metals markets are being forced into a corner where the mismatch between paper contracts and real bullion can no longer be ignored. Let's get back to the interview.
Well, the basic background is it's not so much gold and silver rising. Well, silver may be, but it's not so much gold rising as the dollar and fiat currencies losing purchasing power at an accelerated rate. So that's the background to it. So the idea that this sort of gold bull market is a bull market is actually misunderstanding the whole thing. What we're looking at is a bear market in dollars. And as we go into recession, we've already been in recession for about the last 2 years. If you take the budget deficit out of GDP, you can see pretty much how much GDP is coming out of the private sector. And the answer is a negative figure. So on that basis, you can see that there is absolutely no doubt that dollar is going down, and this will be reflected in far higher gold prices over time. You look at the technical chart, and it just confirms that, etc. So what actually are we talking about? We're talking about the death of the fiat currency system. That is dying. It's as simple as that. It's been running for 54 years. It's now coming to an end. And it's coming to an end because it's just created so much unproductive debt that all our economies, from governments and into private sectors, are just overloaded with this debt. They can go no further. We are sinking in a sea of debt. That is the other side of the credit bubble. For every debt, there is a credit. The credit bubble is it's the biggest one we've seen in history. It's far bigger than 1929. So we have this problem that when you get the death of the of fiat currencies, other things die with it. And obviously, one of the things that dies with it are the stupendously large derivative markets, because we're moving into a situation where, the idea of derivatives is you use them to hedge risk. But we now have a problem that the participants in that market are themselves greater in terms of risk than the risks which we use derivatives to hedge. We just don't want these counterparties. And that is an increasing problem. And we can see this with, in the case of gold, what happened earlier this year? Well, the Bank of England suddenly was shipping gold out, or people who were storing gold in the Bank of England were shipping it out. There's a queue around the block to try and get it out, and the Bank of England was saying it's going to take 6 weeks, whatever. The fact of the matter is that the Bank of England does store some gold for commercial entities, but the vast majority of the gold it stores is actually on behalf of central banks. And those central banks defray the cost of storage by leasing it. Now, under a lease contract, ownership passes, under the terms of the lease, entirely to the other party. So if you've leased gold, which is sitting in the Bank of England, and the Bank of England has long been saying, well, don't worry, this is just a book entry. It just goes across to Charlie who wants to borrow your gold. And at the end of next year or whenever the lease expires, we'll do a contra entry, and so it won't leave the vault. But it's left the vault. What this is doing is it's making central banks very wary of leasing gold. It's just quite obviously, it's the most stupid thing a central bank can now do. What do? They withdraw from the leasing market. And as those leases fall due, they're not being renewed. And I suspect in quite a lot of the cases, the gold is not being returned because it just simply is nowhere to be found. So under these circumstances, what we have is we have the shortage of physical beginning to impact on liquidity in the derivative markets. And we can see this on COMEX with open interest in the gold contract. Despite gold rising into new high ground and, doubling in whatever in the last year or 18 months, you'd think open interest would be 600,000 contracts or something. No, it's sort of only just above the oversold levels. Basically, the squeeze has been on the system. And the same is true in silver. Particularly in the last week or two, we've seen open interest in the silver contract fall while the price shoots up. What's that if it's not a bear squeeze?
What we are seeing will echo substantially from what Alasdair said, but we're seeing a draining of the world's exchanges, at least everywhere else besides the COMEX, which is getting filled. But there's some interesting developments. Last week, there's a man named Bruce Ikemizu, Ikemizu, and he was formerly head of Chinese bank ICBC Tokyo's precious metals desk, and now head of the Japan Bullion Market Association, kind of like the COMEX in Japan. He says the market may already be broken. He says London, to what Alasdair was saying, appears to have virtually no physical platinum available for delivery. He says it seems that there really is no platinum in local London, Zurich, yet continues trading nearly 3 million ounces per day of London promissory note cash contracts for immediate platinum ownership and delivery. Something is about to break, he says. But this is something that we're seeing all over the place. It's not just in London. We're seeing some really crazy, interesting things happen here in the United States as well. And I'll give you an example. If we just take a look, for example, at the first 3 days of the August contract. I've been screaming that we are watching these deliveries since November come in since the election that are ridiculous, that they're so far outside of what is normal. The people need to take notice that the people that are doing this are incredibly sophisticated and well-heeled. You do not see deliveries coming into the COMEX the way that we have been month over month over month over month over month since November and not take notice. Yet you don't hear a damn word by the mainstream. Okay, so the important things are ignored by the mainstream and are covered by guys like you and Alasdair and myself and others in this industry who spend copious amount of time trying to dig The fact that we aren't hearing anything about this is crazy. We've become a net importer of gold since November. That's something that we haven't ever been in my 35-year career. Never, maybe a month here and a month there. Every single month, we're seeing massive amounts of gold and silver being brought into the United States. In the first 3 days of the August contract, we saw over 2 million ounces of gold post for delivery, over 20,100 contracts. Now, I used to say that less than 1% of contracts stood for delivery. During my career, that would be a truism. No one stood for delivery. These contracts were rolled over. These contracts were cash settled. It would be a way for producers or even a company like myself to hedge exposure. If I have 2,000 ounces or 5,000 ounces of gold in my warehouse, I will sell 5,000 on COMEX. If the price goes down on the 5,000 ounces of gold by $100, I'm down $500,000. But what I sold short on COMEX goes up commensurate. So it allows me to be market balanced, market neutral. I don't have any intention whatsoever of taking delivery of those contracts, but that is exactly what we are seeing. And to give you an idea, remember I said less than 1%, just within the first 3 days of the August contract so far, of the 20,126 contracts that were posted, 100% of those contracts, all of them, stood for delivery. That's $7 billion worth of gold that stood for delivery. Now, this is what we've been seeing nonstop. What is also interesting is that the majority of that gold, goodbye, left the exchange.
What stands out most is not just the clash of viewpoints, but the fact that both perspectives are rooted in an undeniable shift already underway. On one side is the argument that any official adjustment of gold's role would only occur after confidence in paper money has completely shattered. On the other side is the belief that preparations for such a reset are already underway, with subtle yet telling moves in global flows, vault withdrawals, and balance sheet strategies. Add to that the mounting evidence of stress in physical markets, shrinking inventories, and the unprecedented scale of bullion imports into the United States, and it becomes harder to dismiss the idea that the monetary foundation is quietly shifting beneath our feet. These aren't isolated signals. They are interconnected threads pointing toward a world where the financial system could be redefined in real time. If the pressure between collapsing trust in paper money and growing reliance on tangible reserves continues to build, could the eventual turning point come far sooner than many expect? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Additionally, if you are interested in Bitcoin-related news, consider subscribing to our other channel for more updates. Thank you for the support, and I hope you enjoy the video.